Hey, good afternoon, everyone. This is Mark Fenton, Senior Mentor with Sheridan Mentoring. Hope you're having a great day. And I want to talk to you today about an earnings trade. What's an earnings trade? Well, that's a trade we put on, a speculative trade at the earnings date, maybe a little before the earnings date. But what I'm going to talk to you about today is what we call the earnings calendar or time spread, where we put the trade on before earnings and we have it off before earnings. Those are very important on both of those. So I'm going to go ahead and share my brokerage screen now. You should all be seeing it here. And what we're seeing here is Exxon. And Exxon currently is trading at 81.95 and kind of hanging around there all day. Now, Exxon reports earnings before the market opens on April 26th, which oddly enough is an expiration day also. So we've got a little bit of time. And what I'm doing here is I'm going to put on a calendar, time spread, same thing, and I'm going to sell the week before earnings come out. That would be April 18th, or a week from this Friday. And I'm going to buy the week after earnings. You say, Mark, why don't you buy the week of earnings? Because many times it's very expensive because that option is getting a lot of volatility built into it, which is part of our theme, all right? So whenever I sell or whenever I buy a calendar of any kind, I'm selling an option with a closer expiration date. It's going to decay faster than the long I buy, normally 2 weeks later, and in this case, 2 weeks later. So I'm taking advantage of the fact that that option is dying off on its time decay while mine is slower. There's a difference between the two. That's where I can make money. That's one of the ways you can make money in a calendar. Now, the other way is volatility. Every option has its own implied volatility. The more of it has, the more it's worth. So if I own an option or I'm long an option, I'd like its volatility to at the very least stay the same, if not go up and make my option worth more. And of course, if I sell an option that I want to buy back cheaper sometime, I'd like it to lose its volatility or at least not keep pace with my long. Well, this is kind of a good setup for that because I bought a long the week after earnings. Now, what's going to happen with that long? Well, it's not going to lose any volatility value till after earnings. It doesn't have the volatility built into it that the earnings week does, but it certainly isn't going anywhere. Its volatility will stay the same because it's after earnings and we don't know what's going to happen. And then I sold the week before. Well, the week before earnings doesn't do anything for you, right? It's not anything that's going to get a big buildup in IV because the news isn't that weak. A big buildup in IV and preparing for price movement happens right when the earnings are going to come out. This option will be expired and gone before earnings even come out. So what you should have here is a trade where your long keeps its IV value, your short doesn't keep its, and it goes ahead and decays fast and expires while the long expires at its normal rate, and you should be able to make money. The only thing that you could possibly have a problem with is if the price moved too much, and you can always make what we call adjustments, adding a second calendar to it or what have you. But I think this is an interesting trade for this earnings season. Exxon's certainly not the only stock you can do something like this in, but I saw it coming up here in a couple of weeks. It's a good solid stock. It's very liquid in the options, so I thought it was a good choice. I hope you guys enjoyed this, and I hope you can put this information to work. Come back and see us as much as you can. Have a good one.